Jackie are going to do likewise. I don't believe we have formal agenda for today, but what we'll do is follow the standard practice, if that's okay with all you gentlemen. I'll do that as best as I can, as best as my memory allows. I should also note, given our schedules, I know Mr. Sonata has to leave for an appointment. I've got something, Dan's got something early afternoon. We can try to get this done in a half an hour. Not to put any pressure on you, Sarah, but
We're just talking, I want Commissioner, I want County to like.
no, we won't do that today, but today's one of those days where everybody knows,
It's
for all I know, you gentlemen might have things going on too.
Commissioner meeting a little longer than anticipated.
Remember when he wasn't here and I had to run it?
Yeah, you
That's
do
how
it
we
like
do
this.
10 minutes.
Okay, the computer is running. Oh, we're on? Good,
Yes, sir.
okay. Thank you, ladies.
Yep.
Good morning, everybody, and welcome. I will call to order this regular quarterly meeting of the Lawrence County Retirement Board. Today is Tuesday, August 11th, and we appreciate everybody joining us. I want to note that this meeting is being live streamed and recorded. Also ask if you have a cell phone, if you'd please put it on vibrate or silent. We appreciate your doing that. Let us begin with the Pledge of Allegiance, and we'll remain standing for a moment of silence. Mr. Prestipine, could you lead us? Sure.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
We'll have a brief moment of silence. Thank you, everybody. To determine if we have a quorum, I'll ask for a roll call, please.
Forgive me, this is my first retirement board.
You're fine.
Do I do everybody?
The 5 people up here,
Okay.
yes.
Commissioner Sanada,
Here.
Mr. Prestipine,
Here.
Mr. O'Connor,
Present.
Commissioner Kennedy.
Here.
Commissioner Vogler.
Here. I'd say you did that very well.
Thank you.
Thank you. We're all present and accounted for. Today we have no minutes for consideration. We'll do that at the next meeting if that's okay with the board. And before we turn it over to Sarah Wilson from Marquette Associates, let me see if my fellow board members have any opening statements, and I'll start with Commissioner Kennedy. I'm good. Treasurer Rapone? No. Controller Prestipine?
Nothing.
And Commissioner Sanada? Well, Sarah, it's always a pleasure to have you with us, and I trust my 2 colleagues behaved themselves in Monroe County.
Yes, they
last
did.
week. I'm not the least bit surprised. You were watching them, right?
I certainly was.
It's her husband.
Well, I hope the conference was good. I know both Chris and Dan spoke well of it.
It was a good conference.
And Mr. Prestipine was in Monroe County recently.
Right before.
For your conference. Was that a nice, I've been there before, Shawnee?
The area was nice.
Yeah. Okay.
It was a good place to have a conference, minus the rooms.
Yeah, the
Oh.
rooms weren't the greatest.
No, but
That's
the
an
whole
older-
atmosphere was great. It's where they, founded the
Yeah, it
PGA.
was around a golf course, the golf
Oh,
course.
did you see any pictures of Jackie
I
Gleason?
did, I took a picture of one for you, I forgot to show you.
That was what, I guess, one of his
That's so
favorite
nice.
golf
That was
courses.
really different.
I'm sorry?
You weren't able to go
Yeah,
down.
obviously, we're-
Oh, no, I was at the Shawnee and Clifton Controllers and the Kalahari. Yes.
Okay, you were close.
I was at Kalahari, yes. I just did both conferences
Oh,
back
okay.
to back.
I understand.
Well, Sarah, I hope you have good news for us. I mean, the report, we're gonna go up through the end of July, July 31 of this year, and then maybe you'll have a little something for August so far. I don't know if you have that. That's okay. So we're gonna be talking about
June,
where we stand. Oh, I'm sorry, through the end of June.
and
Excuse
then
me.
I've got a July update.
Gotcha. Thank you. I'm gonna turn it over to you.
Okay, thank you. Good morning. So we're gonna go through the quarter, and as we know, this quarter was an up quarter. If we go to Exhibit 2, the US economy And I think when we look at everything in what we're reporting, really the theme of everything is AI and how that is really starting to move the economy and some of the good and some of the bad. If you go to page 10 and you look at US economic growth decelerated in the second quarter with real GDP expanding at an annualized rate of 1.5. You can see year over year in that top graph that it's actually gone down, while consumer spending accelerated compared to first quarter. So the consumers started to spend again, keep spending. And I think that's going to be an issue that we see and what that means for the economy going down. Softer government spending and a surge in imports were key headwinds during the quarter. We look that there were imports. We're going to talk a little bit, tariffs was the big concern in the last couple of quarters. And we know that tariffs, some of these companies are getting money back, but they're really not passing that tariff cut back to the consumer. So we haven't really seen the consumer getting cheaper prices. The economy continues to be supported by a massive technology-led investment cycle. And I think this is what we can see. If you look at the bottom, look at the tech investment versus residential investment. Look at that. It's gone up to 5% for the tech, and residential's gone down 3.7. We know capital expenditure has been AI driven, and then AI infrastructure. And we know that, we keep hearing data centers into some places want data centers, some don't. I was listening to Bloomberg this morning. And what they're starting to say is that building that data centers and the infrastructure to that could be considered a whole different part of issuing credit, meaning that can become an investment in itself. You have infrastructure, we see real estate, they're all going into that, but then they're going to start issuing possibly credit just to go into data centers. And that's going to be an interesting sector if they do that. We look at the recent energy vol, price energy, and we look at how that's affected the economy. Look at page 11. You look at computer and software accessories. We look at AI infrastructure has tightened supply among key components, including high bandwidth memory, advanced semiconductors, networking equipment. As a result, pricing of many of these inputs has firmed, contributing to higher capital good prices. One of the things that we look at is we look at what's happened with Apple. CPI report notwithstanding the recent sharp decline in oil prices. So oil prices, we know, hit over 100. We know when the Strait opened up, it was going to take 2 months for that kind of the oil prices to go down to actually hit the consumer. What happened though, is we remember, is that oil prices, when they were up and the Strait was closed, we know that 2/3 of the world fertilizer went through that Strait. So we've had this huge, then fertilizer went up, that demand has gone up. Now that it's opened up, we see oil in the 70s. It hasn't really gone back to the consumer and hasn't gone back to pricing. Meaning food still is expensive. We look at everything. And now with AI, going out where it's gone, they're starting to increase their prices. So the average price of a cell phone has gone up probably 35% in the last 6 months. And then we talk about this consumer and we look at prices and what's the magic words, it's inflation. Interestingly enough, you can look at short-term interest rates below. I think one of the things that has happened putting this new chair in, Kevin Walsh, as the new chairman, he came out and he said, I am no longer going to really kind of give notes that are so in depth, meaning we don't know where the Fed's going to go. Usually we knew, when we read the minutes from the meeting, you would know where the Fed was going to go from the next quarter to the next year. And he's not going to do that. Interestingly enough, options on where the Fed's going to go within the market have accelerated because they don't know. We believe, and the market believes right now, that we're going to actually see a rate hike of 25 basis points, which is going to have some effect on the economy. They're still trying to fight this inflation. They want it down 2%. Is that, realistic? I don't know if that's really realistic with the current conditions. And then we also look at, unemployment's low, consumer spending kind of still keeps going and going, meaning you have inflation and prices. So if the Fed raises rates, then we're gonna see that will have an effect on small and mid-cap companies. It's also gonna have an effect on the consumer. If you turn the page, you look at the global, we know we're a global economy. One of the things that you can see is, look at the forecast. I thought this was interesting. As of January, India, global economic growth in India has been 6.4%. So they are really starting to grow. And then we look at what's happened with China and China exports. High and new tech products are up 50.9% year to date. And they've also had exports were up at the beginning of the year, detracted, and now they're back up again. And that is the magic word. If you see that dip at the end of that are the tariffs. And then yet again, global IA has been going there. Look at page 13. We look at what's happened in the market. We had a great quarter. U.S. equities were up 15%. Emerging markets were up 24%, and U.S. bonds were up 0.7. We do know that if interest rates go up, bonds are going to start going down. One of the things that we're going to do is that we've talked about it on the OCIO committee. We are going to take, if we have to rebalance you, we're probably going to see a little bit more going into cash, meaning we're not going to go put it back into fixed. If we take you down to target right now, we're probably going to put some of it into cash because you're going to get more return on cash because fixed income's now in negative territory as of July. So when we look at that, we know if interest rates go up, we're probably going to be more comfortable putting it into cash. We look at commodities, no wonder they're down 8.1. With oil, with gold hitting over 5,000s, now retracted down to the 4,000s. Silver was up to 100s, now back down to 60. You can see that real estate had a good quarter. International bonds were up for the quarter and down for the year. Are there any questions? Let's turn this.
The bonds have taken, I know the bonds have taken a major hit this year.
They are, yes. And it was great because last year we saw bonds in really positive territory. And that's one of the reasons why when we redid your asset allocation, you went way down on bonds. Because I think when we started, it was like 60-40 almost. And then it's down to 20%. If you turn the page, you can see what's going on with U.S. equities. You can see what did well. Consumer discretionary kind of went down a little bit. Energy, no reason. It was down 12.9. That's just pricing, but look for the last 12 months, 29.4%. Information technology is still leading the way. And this is where this market is completely being driven by 7 stocks, being driven by one sector. And eventually, that's going to have to kind of weed itself out. It can't keep going and going and going. When it will change, we're not sure. From a style perspective, growth stocks outperform value. You will see that you trailed a little bit on your benchmark. And then for July with the update, you were ahead of the benchmark because we know we always try and support in a down market. And then we look at what's been going on with earning growth. Turn to page 15. And this is what I think is very interesting. Go look at where earning growth is, the S&P 500. For example, 2 companies alone, Micron and NVIDIA, are projected to account for more than 40% of the aggregate S&P 500 earnings growth in the second quarter. If you think about that, 2 companies are moving that much of the earning growth, and then you look at what's reported and what's expected, and we look at reported, and you see earnings growth have been up, and that really held the market. That is why we saw when earnings came in at the first half of this year, have propped up the market, and they've had some good earnings growth. Look at what we see, what's expected. But then when you look at excluding Amazon, Google, and NVIDIA and other income, it's much smaller under that first quarter of 2026. In fact, free cash flow for the 4 major hyperscalers is projected to fall approximately 75% in 2026, meaning that they are just putting so much money into the infrastructure of AI and then they've got to build data centers. And what they're doing is they're just spending all their cash right now. And then what happens in the next couple of years? And we probably did this graph a couple of quarters ago that showed that eventually at the end of 2027 and 2028, what they are projecting in earnings is going to come back to being more realistic. You know, it was 556 billion this year, so it's going to kind of slowly start to drop. Are there any questions about the market? All right, let's go to Exhibit 3 and see where you are, and then we'll talk a little bit about your managers. So at the end of June, you're at 124.3 million. You had a return of 8.7 with a net investment gain of 10 million. Year to date, you returned 7.5 with a net investment gain of 8.8. Since inception, since Pierce Parks Marquette has been here, the fund has annualized return of 8.5 and a net investment gain of 89.3 million. Positive attribution was your global manager, WCM. We know they struggled in the past, so a little bit back up. Real estate and infrastructure did well, outperformed their benchmark. And then non-US equity DFA, it's just struggled. It's just not its environment right now for outperforming. And then low investment management annualized fees, we've got you all in at 26 basis points, which is very low. And you can see year to date, we're a little bit behind. You can see below on page 23 with your return 7.5 versus 7.7. That's really not a concern. The first quarter you outperformed when it was a down market, and in July you've outperformed. Are there any specific questions on this? Let's turn to page 32. Okay, so page 32, you look at MFS. In May of 2026, we talked about this. Last quarter when I was out here, we fired Eaton Vance, your small kit manager. We replaced them with MFS. You can see they've done very well, 9.3 versus 6%. You go to page 33, you look at your global managers. Dodge & Cox, just in this environment, has been up and down. We are not concerned with them at all, and actually they've done well in July. Look at WCM, did 21.1 versus 19.8 since we put them in March 2025. You look all the way over, they've annualized 27 versus 25. MFS low volatility has done very, very well, 3.1 versus 2.3, and year to date 3.6 versus 1.9. I can say because we have two MFS products in your portfolio, it's really rare that we'll usually do two with the same manager, that we are watching it extremely closely. They just, when we go look for managers and we have to replace Eaton Vance, they were just the best one to replace it. So you won't, normally don't see that, so we are watching that very, very closely. And they've done very, very well. Non-US equity, you can just see DFA has struggled a little bit since we put them in, and they actually have over 7,000 stocks in their portfolio versus their index of 2,500. It's just their style, and there are times where they will do very well. They're a core manager, and it's emerging markets. Emerging markets are very, they are susceptible to currency, and we've had a lot of currency, volatility. 2 weeks ago, Japan just got bailed out from us. With the yen. The yen was almost worthless, and we bailed them out, which is kind of quiet. Nobody really kind of heard about that. So we bailed out the yen. So you started to see a lot of currency changes. If you go to page 34, you can see real estate. Remember, real estate was funded with 50% of fixed income. So they're right there. Year to date, they did 2.6 versus 2.3. They are a great hedge for inflation, and they do produce a nice dividend. And you can see they've done annualized 4.1 versus 3.9 since inception. That's great. We like the dividend with them. We like their inflation hedge. And we know that real estate has completely changed what they're investing in after the whole COVID, with, people not going back to work. They got a lot of the losses off the books. Infrastructure, yet again, 2.2 versus 1.4. JP Morgan's done very well for you. For 1 year, they've done 11% versus 6. And since we've put them in 10.5 versus 6.6, they're an inflation hedge. They will do very well, we expect, in the next couple of years. Plus, they're producing very nice dividend. Defensive equity did not do well in the quarter, but actually kind of came back in July. And you can see since we put them in September 2021, they've annualized 9% versus 8.4. For the trailing 12 months, they did 15.6 versus 12.9. What you're going to start seeing is you're going to see a little bit of some of these managers not benching as closely to their benchmarks just because of the massive volatility that we're starting to see and the concentration with the AI stocks, the Magnificent Seven. And then you go to page 35 and look at U.S. fixed income, and this is why we really have diversified. Now it's at 21.4% of your portfolio. You can see year to date it's done 0.8 versus 0.6. Sees McKee, your active manager against the U.S. aggregate, has done for the year to date 0.8 versus 0.6. There's really not that much return in fixed income. And then you go look at the cash equivalent for the same year to date, cash is down 1.6. Hence why, if we rebalance, we're gonna probably put a little bit more into cash. Are there any questions? And then the only thing I wanted to do is if you turn the page and go to page 37, you can see your fee schedule, and you've got a very low fee schedule compared to what is actually the norm. And if you look at the bottom, because Marquette is able to go in because of size and go negotiate fees, right now, because you're a Marquette client, you're saving $63,620 a year on management fees. And if you look at that, the expense ratio is 0.26 versus the industry median of 51. So we really are very fee cautious. And you've got a great active portfolio managers in the places that make sense and the places that it doesn't. We just put them into like the large cap. We always talk about that. It's very hard to find a large cap manager that's going to outperform consistently, that's worth how much they charge you. You can see, so the index is 0.2 on there, but then we look at MFS is 0.52 because they're your active manager, but all in, you're at 26. So that's a really nice fee for you. Are there any questions? Well, it was great to see everybody. And going forward, let's just jump and look at this. Lawrence, we'll go to just very quickly page 2. So as of now, August is up. The S&P, the Nasdaq's up about 5%. It can change, but July was down a little bit, and you were down 0.2 versus the benchmark of 0.4. And that's where this is built to protect you in the down market. So year to date, you're ahead 7.3 versus 7.2, and section 8.4 versus 8.7. And then just look at page 3. We see how managers change in different environments. And if you go to the global equity, you could see that Dodge & Cox that was trailing last month was at 3.5 versus 3.1. WCMA, which was ahead, was down a little bit. So that's what we do. You build it. It's almost like a puzzle. Some will do well in one environment, some will do well in a different environment. And then the only thing that we can say is that we are looking at DFA, which is your emerging manager. We are not concerned right now. They are off the benchmark, but it's not we're not concerned due to this market. But we do, look at these companies and look at your account every week.
So July was basically a wash, wasn't it?
Yeah.
For our.
Yeah, it was, it was, and it was the way the market
But
was.
the second quarter was a good,
The
productive
second
quarter for
quarter
us.
was good, and if you ended up flat and the market did nothing, which would be really nice, you would end up at 7.3% for the year, which is, you've lowered your actuarial assumption. There's a lot of counties that, are still at 7%, some are at 7.25%. So if it just ended straight at, 7-8%, it would be nice for everybody. but I'm not saying we don't know. There's a lot of if, ands, and buts out there. You know, the Middle East crisis is not solved. You know, Iran's not solved. Russia and Ukraine, we don't even talk about that anymore. You've got Argentina, you've got the Fed that you don't know what they're doing, and then you've got midterm elections. So depending on what happens on midterm elections, that's gonna kind of set the tone on what policies will get in and what policies won't.
Well, as always, we appreciate the very thorough and helpful report that you give us. And I'm going to see, starting with Commissioner Sanada, see if he has any questions.
Just echo the chairman, I think, you know, considering the market and everything, I think we're in fairly good shape. Where are we at? Are we at 100% yet? Are we still over 100?
Yes,
As far as funded, yeah,
Yeah.
it was a 99.
9 point,
We're almost there. I mean,
It's 99%,
yeah, that's
just about 100.
and that changes a little bit with just the dynamics on who's retiring and, you know,
oh, that's an excellent number.
yes, it is. You were overfunded, then you could go down a little bit, and remember 2 years ago, we were double-digit negative, so it just depends on that, but you're in excellent shape.
Yeah, I mean, I just see anytime it goes to 100, that's amazing. So, thank you.
Well, that's as of December 31st or January 1st of 2026, we were at 99%.
Anything else, Chris?
No.
Mr. Prestopine?
No, nothing.
Mr. Rapone? No, thank you. Thank you. Mr. Kennedy?
No, as we talked last week, thank you. You've done a great job.
Let's make certain our calendars agree. Let's see, this is August, September, October, November, so sometime in
November
November.
already.
I have the 17th written down, Tuesday the 17th. I'll see if anybody can,
That's what I have.
good,
Probably what I have. I think we,
of November. Yes, sir, that works good for me.
I think it's
not
because
till
of CCAP and the
22nd.
controllers that kind of things,
Your CCAP starts on the 22nd, so we're okay. I don't know if that goofs you gentlemen up at all, 17th.
Yep, I've got it in on the 17th,
Great?
Yep.
All righty.
and it's a snowstorm.
Yeah. Again, Sarah, thank you so kindly, and it's always a pleasure to have you join us. I'll see if my colleagues have, by the way, we didn't take time, and I'm at fault, we didn't take time for public comment. Let me note for the record, there are no members of the public either right now or were there any at the beginning of the meeting. So I should have announced public comment, I didn't, but it'd be somewhat of a moot point because let the record show there were no members of the public in this meeting. So forgive me for that oversight. Closing comments from my fellow board members. Anything else you gentlemen wish to bring up? Mr. Kennedy?
Nothing.
No? Mr. Rapone? Mr. Prestopine?
Nothing.
And he, you know, being the secretary of the board and kind of the housekeeper, you know, we always look to you. No other matters that we need to be thinking about, or everything's in order to the best of your knowledge?
Correct.
Okay, great, thank you. And Commissioner Sanada?
Everything's fine.
Well, Sarah, like I say, it's always a pleasure, and we appreciate your taking the time to join us.
All right, well, thank you. It's a pleasure working with all of you.
Thank you. A friend of mine used to say it's a business doing pleasure with you.
That was fast.
There being no other business to be brought before the board, would one of you wish to make an adjournment motion?
I'll make the motion to adjourn.
Thank you, sir. Is the second by Mr. Rapone? All those in favor of adjourning, please say aye. Aye. Opposed, same sign. Motion carries. This meeting's adjourned. Thank you, everybody. Someone's gonna have to turn off the computer if we could, please, although I'm not the one that can do that. Maybe IT will be coming in. So, Sarah, thank you.
You're welcome.
Great.
See you right
We're just
before,
finishing our retirement board meeting.
see you
We'll see ya.
in November. I'll get that info too.
Okay, yeah, let me know.
Yeah, I will.
And the fund's in good shape. We did get a
I'll see you.
good
When is it? October?
investment person. Anyways, are you okay?
You going to the next one? I don't know if I'm going to the next one or not.